Well, I am Steve Savant, your host for the Quest for Financial Freedom, brought to you by Brokers Alliance. Need financial guidance? Call Brokers Alliance. I want to welcome everyone listening on the Family Values Radio Network and over the World Wide Web on YouTube, Ustream, Vimeo, Facebook, LinkedIn, Twitter, and the Insurance Forum. You can contact me on my email address, thequest@brokersalliance.com, or toll-free call us, 1-800-290-7226. It's not what I know, it's who I know, and that's why my special guest on the Quest, now turning in to be my co-host, Eric Palmer. Hey, Eric, how you doing?
Glad to be here. I'm doing well.
Well, all this week we've been doing our Valentine's tribute to life insurance. Nothing says I love you like life insurance, okay? And you know what? If you're still 5 days, I've been saying this every day, is better late than never. If you haven't bought something for your loved one, first of all, you're in the serious doghouse, okay? But you could get away with it by giving her a great card, a nice roses, taking her out, and putting the canceled check that you sent to the insurance company and the life insurance company to show how much you love her, okay? And nothing says I love you, dear, than a big $1 million policy, because she wants to kill you and collect. Well, today, listen, we're having too much fun in the program today. Today on the Quest, all this week we've been talking about life insurance, again, the product that says I love you, and I really want to talk about today, there's an aspect of this that we really generally don't get into. And that is, there's tax-advantaged income to be had here, and it's really exciting because we can really minimize the cost of insurance and pull money out absolutely tax-free. And by the way, Eric, that tax-free has more than just tax-free from the policy. It doesn't affect other income vehicles as well. We'll get into that in a second.
Yeah, you know, there's the common reason for buying life insurance is that death benefit. But again, we talked about it a couple of times throughout the week. There's cash surrender value built up inside these policies, and that pool of money is available via loans, basically, from your own life insurance company. So you have the ability of loaning yourself from your own policy these cash values. And when you take a loan out of a policy, the IRS says it's tax-free.
I'm amazed. And you could take withdrawals to basis depending upon what year. And I don't want to get too deep into that, but in the appropriate years under the code, you could take withdrawals to basis and policy loans to gain, providing that you kept the contract in force for the life of the client. Right. You know, because if they decide to cash the policy in, all those loans become ordinary income tax in the year that they surrender it or it lapses, or, God forbid, the policy went to the maturity date.
Right. There's different combinations that make this appropriate, but whether it's a loan or a withdrawal, there's going to be particular variations inside each policy per the company. Also, you know, if you're doing a full surrender of the contract, there's surrender penalties, there's other things that can come into play there. But we actually have the ability to illustrate the max loan or withdrawal value that's going to be tax-free based on a given scenario. So if you have a client, 55 years old, they're looking for roughly $500,000 in coverage, we can actually show you what a policy like that could do in terms of income while the client's alive. And usually we like to look at income from the point of retirement or where they want to start all the way to age 100.
I'm kind of interested. What about the cost of the loan? I mean, nothing's free.
Right.
But what about loans from your own contract? They don't seem to be that high to me.
They're not that bad. You look at a loan rate, sometimes if it's we call it like the fixed loan, where it's maybe a 2.5% rate, and there's a spread that the insurance company's putting on for a certain number of years. So for the first 10 or so years of the policy, you might be paying a total of about 3.5–4% in terms of your cost of your loan, and after year 11, maybe that spread drops off and it's just a minimum of 2.5%. Some insurance companies use what is known as like a Moody's rate, which is kind of like that general prime rate out in the market today. Or we see a variable loan rate where there's a potential increasability or decreasability of the rate. It's based on the current interest rate environment, and we usually see ceilings or floors there, so it can't go too far out of bounds in terms of the rate. And
but that's the loan rate. That's not the crediting back to the client yet.
Right. That's how much the money's costing to pull out, basically.
Yeah.
But
so his actual net could be 25, 50 basis points or 0.5%. That's a pretty dang good loan. I mean,
it's not bad at all. And so what we look at a lot of times are these index universal life contracts. And the reason we're looking at those is because typically we can give ourselves the opportunity because of that upside of the indexing, you can earn up, like we said, I think it was earlier, 12 to 15% in some contracts, where you're not only able to potentially cover the cost of that loan, but make a considerable interest rate still on the cash value, which makes those loans more possible and gives you more to pull out potentially in the future.
Well, I really like using life insurance as a supplemental income scenario. Maybe I have already a 401k. I like to use the tax savings on my 401k and let Uncle Sam pick up the tab for this.
Right.
You know, if you're going to save money on your 401k, listen, we are totally into using your 401k, especially if your employer's matching it. I mean, all the way.
Absolutely.
Get the deduction up front, but take the deduction. You know, we always we hear phrases like buy term and invest the difference, but nobody ever invests the difference.
Right.
We hear people say, go into the 401k and take your tax savings and put it into another tax-deferred vehicle, but nobody does it.
Right.
See, you can have all these wonderful axioms, right? These platitudes that we use all the time, but if you don't use them, what good are they?
Well, and if you're not, fully taking advantage of those vehicles, like we said, buy the term, invest the difference, it's too easy to spend that money and not invest it. So, the life insurance, like you said, it's supplemental. We certainly don't look at it for that number one only a source of your retirement income. But what a great supplement, especially because it's coming out tax-free. We can really use that to arbitrage the difference between some of those taxable income sources that we have in retirement.
Think about this. I just want to make sure everybody gets this because it is kind of huge. Not only do we, as long as, and I want to say the caveat to all this, that appropriate withdrawals to basis in the right years, because there's some years where it wouldn't be good to do this, withdrawals to basis and policy loans to gain in a contract that is a non-modified endowment contract. It's a lot of words. If you want information on that, we'll send it to you. Of course, just write us here, thequest at brokersalliance.com, or call us 1-800-290-7226. As long as you keep the contract in force for the life of the insured, you should not have to pay ordinary income tax on any of the gain on this contract. Now, I want to further state that even though life insurance in some scenarios is actually classified as a preference item, which means it could be subject to the AMT, the alternative minimum tax, in the scenario that we're addressing, it does not come under, it's not subjugated to the alternative minimum tax. So this is an extra bonus. Even though we are kind of a preference item, we really aren't subject to the AMT. So unlike, let me think of a preference item, like municipal bonds. Municipal bonds are subject to the AMT. If you load up too much on the municipal bond, the government goes, hey, I know what you're doing here. You're trying to escape and, kind of skirt taxes. And they'll say, well, you need to pay a minimum because you're really loading up on oil and gas leasing, another preference item. You're loading up for the tax credits.
And a lot of times we find consumers drawn to those types of investments because of the level of conservatism behind them. But in reality, life insurance is right there along with it. It's a conservative investment. It's not that crazy investment that's going to get you 30-40% gains, but the potential is there for these products, and that.
Well, you're not going to get a 40% gain from a municipal bond. You're not going to get 40% unless you hit a gusher, on the oil and tax credits.
But they're another option in that same sort of category, and a lot of times we find it isn't even brought up to the client. So when we mention, oh, hey, what about life insurance, and then we show them the tax advantages, the eyes light up and they realize that it's pretty significant.
The normal consumer has not been introduced to this supplemental income vehicle, and yet the high-end affluent clients have been playing in this league for a long time. I mean, the big boys, when it comes to whether it's 162 bonus arrangements for businesses,
deferred comps,
deferred
succession planning.
Yes, everybody sees the value of this.
They know the power of the tax-free cash values, and I think it's important to note too. It's not something where you flip a switch and then you're stuck getting these payments every year too. It's a flexibility issue. You can pull out the money one year, you might not need it the next. You can take a loan the next year. You can take a withdrawal the next. I mean, you're not stuck doing one particular thing. You don't even have to pay them back. Now, again, you mentioned before, we can't let that policy lapse. We got to make sure that policy stays in force, for the life of the insured. But
and you have to be careful what you take out at so much because you want to maintain the integrity of the contract.
Right. But the great thing is that we have the ability to evaluate these things on an annual basis to let you know you're still on track. We can do an analysis, a life insurance review, or an audit of these policies to make sure that we're still able to take out the money that the client wants to take, or we can tell them exactly how much they can take and not affect the actual longevity of the policy. So that expertise is something that we provide our advisors because, you know, it's intricate. It's not always the same. But again, the flexibility is what I like the most. You can take out $10,000 one year, $15,000 the next. It doesn't have to be the same thing every time, and it could be supplement to whatever else you have going on in retirement.
Speaking of retirement, not only do I want to add another thing to this is really another huge issue. Not only do you not pay taxes on this if it's done the way we've been talking about, and not only would it never trigger an alternative minimum tax like other preference items, but it will not be counted as the provisional income test for whether your Social Security benefits get taxed or not. Now you're into a whole nother game. Right, let me give you an example here of this because this is just shocking when you come back and you find out, oh my goodness, I didn't know. I saw this person, he got on his 1040, he had a capital gain. And, of course, he only paid 15%, so he was celebrating that. But then his income of the capital gain was still qualified or counted for his provisional income test because it was still counted as income. And so he was celebrating 15%, but by the time we did the math, he was probably into it. His capital gain income actually cost him part of his Social Security, so he was like 20%, 3% in on because of this inclusion into Social Security provisional income test.
Right.
Now, the reason we bring this up is because I believe in net spendable income. I want to know my all-in price. I want to know exactly what my net number is. So, spendable. It's not what my rate of return is.
How much can I actually spend? That's
I want to
exactly
know
right.
what can I take home in my wallet. And I hope it's a lot. And I got a big wallet for Valentine's Day, so I want a big one. Coming up in our next segment, we're going to talk about this really strange idea, survivorship. You're listening to Financial Freedom. We'll be right back after the break.
Economists call the first 10 years of the new century the lost decade, where most Americans experienced a level of unprecedented financial loss. But some savers and investors found one sector of products that actually made them money. Products that were guaranteed, tax-advantaged, and backed by some of the biggest names in the business. Now, focus on the returns on your money without worrying about the return of your money. For over 30 years, Brokers Alliance has maintained one of the largest inventories of guaranteed and tax-advantaged products in the country and serves a nationwide network of financial professionals